Today, the conversation is around the Treasury basis trade, which we all love talking about. It's basically when hedge funds distort the prices between futures and the underlying Treasury. Citadel founder Ken Griffin has a lot to say on it. Joining us now is Bloomberg's Sonali Basak. He was talking to the FT, really came out against it, said, look, talk to the dealers, talk to banks, talk to those guys, don't look at us. He's talking his book.
Well, on one hand here, you have Ken Griffin, you have Citadel, the hedge fund, and Citadel Securities, which is an intermediary in Treasury markets. So they are very involved in the basis trade from all angles, if you will, here. But, you know, the interesting thing he told the FT, let's read exactly what he said. He said the SEC is searching for a problem, and if regulators are really worried about the size of the basis trade, they could ask the banks to conduct stress tests to see if they have enough collateral from their counterparties. Why do we love this idea? The banks are already facing stress tests, number one. And number two, it's amazing to most people on Wall Street how opaque the Treasury market is when it comes to leverage under the system, when it comes to clearing on all parts. There's a lot of discussion around central clearing. There's a lot of discussion around why the basis trade can so easily become a trade that's levered to 100 to 1. There's a counterpart here. This is also a trade that is also put on in part by a Treasury short or a futures short. Remember, those trades already require a certain degree of collateral here. We also know that regulators are thinking about broader haircuts from the banking system. So one part of that trade could require more margin as well. So there's a lot that's potentially changing here about the trade. And what Griffin is saying is put the onus on the banks. And the banks are saying the SEC should have more clarity here.
Sonali, is there any way of looking at the banks and getting an idea how big their exposure is? If you look at the prime operations, is there a way of determining, even with retrospect, what the potential exposure could be?
The complication here, Guy, is that repo financing to finance this trade doesn't always come entirely from the banks. Some of it comes from the banks, and they usually come from different banks. So, you know, you could have a trade where Goldman and Barclays are on one side, but then sponsored repo, where is essentially coming from the money market system, is supporting some of this trade as well. So all in all, it's really hard for banks even to see the entirety of the trade. I will say, when you look at those record short positions that the hedge funds are putting on, banks will even tell you right now that number doesn't really tell the whole story. A lot of that positioning is supporting the basis trade, and therefore it looks very exacerbated when you look at that Treasury short position, and not to mention some people are just betting directionally. But yes, it is hard for the banks to see the entirety of the exposure here. Over time, bankers have told me they're concerned. They're not quite concerned right now because they don't think that the basis trade is as large as you see it in the short position interest that you're seeing. But it has been an issue in the past. The Fed has had to step in repo markets at least twice because of the underlying stress in repo markets, in part of how it was used to finance this trade.
So another thing that Ken Griffin was saying, too, is that if there is more scrutiny, it's going to disrupt the financial system because money will be taken out in different places, and then that's going to harm everything. You're kind of smiling. Is that true?
I find this part of the argument fascinating because if you look at how much Treasury issuance is coming into the system and this idea that foreign buyers are starting to step back, who is the marginal buyer of new Treasury issuance? It is hedge funds, it's levered funds, and it is the retail investor, the American households. And so if the levered funds are such a big part of the buying story, as we're thinking about more issuance in the next even year or so, I've had one prominent trader, for example, tell me liquidity could severely dry up into the middle of next year as you watch bank balance sheets start to shrink, only making those hedge funds even more important. So if you think about how important the hedge funds are into this new Treasury issuance environment, Ken Griffin is making a point that a lot of people see as very relevant because they are the marginal buyer in this Treasury market. And so if this trade doesn't exist, where does the liquidity come from? Double-edged sword.
Sonali, is this going anywhere?
It's exhausting and it's fascinating because you have the SEC looking at this, you have the Federal Reserve looking at this, you have the Bank of International Settlements looking at this, you have the Treasury Department looking at this. Pretty much every major regulator around the world has concerns, and their concern here is not a hedge fund taking on major losses. Their concern is fundamentally the way the plumbing of the financial system works and what roles hedge funds and hedge fund leverage play in that. And, you know, I think everyone can agree here, some transparency at the minimum on how it's working and where there could be hiccups is something that could be very welcome for a lot of parts of the industry.